Tonight, I'm Shibani Gharat joining you all from the Mumbai studio, and my colleague Sumita Karir joins us from our Delhi studio. Now, in global markets today, signs of a geopolitical thaw are rippling through commodities. The United States and Iran are set to hold high-stakes nuclear talks in Oman tomorrow. The discussions will focus on Tehran's nuclear program. The prospect of de-escalation has eased supply disruption fears, pushing oil prices lower. Brent, crude, U.S. West Texas Intermediate both fell more than 1.5%. Some reports showing drops over 2% as the geopolitical risk premium unwinds. Precious metals are also under pressure, isn't it, Sumita? Gold and silver prices have declined sharply today.
Absolutely, Shibani, but the big question is, for how long will these prices keep declining? Is this something near-term or a longer-term trend that we're seeing? In fact, speaking of gold and silver prices, they declined sharply today. It was weighed down by a stronger U.S. dollar and positive signals from the U.S.-China talks, including discussions between President Trump and President Xi, both of them hinting at easing trade tensions between the two sides and, of course, potential increased Chinese purchases of U.S. goods. In fact, reduced safe haven demand has also contributed to the pullback, and this raises the essential question: is the bull run for precious metals over? While analysts remain divided, some view the recent volatility as normal in an ongoing structural uptrend, with forecasts still pointing to higher levels later in 2026. However, others are cautioning that the persistent dollar strength and improving global risk sentiment could cap gains. Ladies and gentlemen, we'll be joined by two stellar market guests to help us decode what's in store in the near future. But let's first take a look at what my colleague Merrill has filed, especially when it comes to precious metals and the way that they have rallied, particularly gold and silver, along with crude, and now the fact that they have cooled off. Merrill?
Well, yes, oil has fallen for the first time in 3 days after Iran has confirmed that it would hold negotiations with the US, which has lowered the immediate risk of military strikes against the OPEC producer. This after it has added around 5% in the last two trading sessions. But gold and silver as well have snapped their 2-day gaining streaks in what looks like a global metal sell-off. Well, silver has retreated by more than a third from its all-time high hit back on the 29th of Jan in what looks like the steepest crash for silver since 1980. Well, this comes from a number of reasons. Call it investor profit taking after seeing a record high, or sentiments of a strengthening dollar, but even a reduced safe haven demand. What this comes from is, well, Kevin Warsh, who was the youngest federal governor in history back in 2008, who navigated through a subprime mortgage crisis and the financial crisis in 2008, which was one of the worst that the world has ever seen, has now been nominated to lead the Federal Reserve. And his views have seemed to strengthen the market sentiment, with expectations for a stronger dollar, causing a reversal in the safe haven buying that had seen driving up the prices of gold and silver, with both metals now seeing a sharp drop-off in today's trade.
So that was my colleague Merrill giving us an understanding and a download on what has really happened. But to discuss this, we are joined in by Sunil Subramanian, who's a market expert, along with Arnab, a global market strategist. Gentlemen, welcome to ET. Now, my first question over to you, Sunil, ever smiling. Thank you for joining us. And my first question to you is, silver has crashed, although silver and gold have seen considerable rally over the past 1 year, but it has crashed sizably this February. Do you see that this is momentary, or, will it continue to crash going forward? What is your outlook on silver and precious metals overall? Do you still remain bullish on them as you were like almost a month ago?
So, first of all, let's look at it from the fact that while gold and silver are both precious metals, silver has a complicated supply shortage as well as an industrial demand complicating its life. So second is it's far, far lesser in quantity than gold. So they say that when gold sneezes, silver catches a cold, right? So the small drop in gold, right now, what's happening is an unwinding of speculative positions. So let me make that very clear, right? Now, the point is that gold and silver have rallied because of what you might call a war premium. And with Mr. Trump and Mr. Xi talking, with the Iran talks being taking place tomorrow, is there a peace dividend coming and hurting them? Is the question. I think that, first of all, one has to bear in mind that Mr. Trump's these meetings in the past have proved to be very ephemeral. Remember the Putin meeting in Alaska when we thought that the war was going to get solved, and months later we are nowhere. So these are, I think, just attempts by Mr. Trump. I think the Trump uncertainty risk premium still prevails. And so I retain my view that both the precious metals carry two forms of drivers for prices, right? One was the de-dollarization move, right? And the second was the geopolitical safe haven move. So it's that safe haven move which is slightly taken a beating. That much of a premium is now coming off, and people who had built the opposite positions are unwinding them. But the de-dollarization, I suspect, still continues. Now that's where you mentioned Mr. Walsh, right? Now, it's a very complicated thing. If you ask by a simple logic, right, Mr. Trump has been crying himself hoarse about a rate cut. Now, why on earth would he go and choose a person whose stated position is on inflation hawk? So there is something puzzling here. And so I would still wait for Mr. Walsh to come out and say, is it a change, Mr. Walsh, or is the old Mr. Walsh going to come back? Because why would Mr. Trump, who's very clearly got a business mind in his place, and he's going to choose somebody who's going to be compliant or at least willing to look at his side of the argument? So this appointment is what has thrown a real spanner or a monkey wrench into the works, right? Because totally unexpected, and that's what led to the sell-off. Because if he's an inflation hawk, and he's then not going to cut rates with the speed Mr. Trump expects, you're going to have a stronger dollar. You're going to have a dollar, decimation or weakening going on, and naturally precious metals will lose their arm. So I would still say that it's still a wait and watch to see how the Iran talks go, what happens with China in terms of the next few weeks, and what Mr. Walsh's first statements come out in terms of his position. All of these are going to have a bearing, but medium term, if you look at it, I don't think anybody is going to be in a position to trust Mr. Trump just because they've signed a deal with Mr. Trump. I think his flip-flops, his uncertainty that he brings to whatever he does is an incredible thing. And emerging countries who've been gradually getting rid of their dollar exposures and gradually accumulating in gold and other precious metals are, I suspect, going to continue doing that at least for the rest of his term. So I think whatever you said and done, it's just a speculative position getting unwound. What the future holds, I'd like to wait and hear what my fellow panelists is going to say.
Absolutely. And ephemeral is a word that you use, and that perhaps best describes what's really happening. But two very important points that you mentioned about rate cuts and, of course, the China factor. Mr. Subramanian will delve deeper upon those factors during the course of this discussion. But let me get in some thoughts from Mr. Das as well. Mr. Das, when we particularly talk about crude and with respect to these talks that are scheduled for tomorrow between US and Iran, are you anticipating and expecting any real breakthrough given the fact that US wants to push Iran for zero enrichment and Iran won't accept? What are investors penciling in so far as these talks between the United States and Iran are concerned?
Well, thanks for having me. Yeah, look, I think, we are seeing a bit of a topsy-turvy kind of world in the geopolitical risk spectrum, as has just been mentioned to some degree. I think, it's no secret that President Trump wants to get the price of oil down. He thinks, and he has, quite a lot to, base this on, that in order to get inflation down, one way to do that in the U.S. and other countries around the world would be to get the price of oil down. And so, Venezuela, which is marginal in the oil market, been marginalized because of sanctions and because of the degradation of output by Venezuela. The seizure, if you want to call it the kidnapping of the president of Venezuela, opens up the prospect that there'd be some long-term downward pressure on the oil price. It'll take Venezuela some time to get back on stream, but that's the direction of travel. Iran, through sanctions, also been somewhat marginalized in the global oil market, and the same is happening to Russia. Now, if Iran is brought in from the cold, some of that supply will come back on stream, and I think that's clearly one thing that's going on in the oil market. Even if the kind of pressure on Russia continues, Trump, although he's been very ebullient and quite nice in many respects about President Putin, has actually tightened a number of the economic sanctions on Russia, including imposing sanctions on Lukoil and Rosneft, as well as trying to punish India for purchasing Russian oil, which was something the Biden administration not just looked the other way on, but appears to have encouraged in many respects, right? So there are these offsetting factors going on, but they're probably pushing the price of oil down. The strength of the dollar, because of some reversal of the de-dollarization trade and the debasement trade, as has just been discussed, is also a factor, right? Because obviously oil and other commodities still continue to be priced in dollars. I think it's important to say here that, I think President Trump, who was riding high after, the event in Venezuela, has been somewhat restrained. He had this incredibly disruptive speech, as I'm sure everyone remembers, at the Davos World Economic Forum, where he threatened, the annexation, seizure, use of force, whatever, as well as bargaining around Greenland, which also gave a significant boost to uncertainty and helped push the price of gold and silver up as well. He then stepped back from that, maybe because of pressure from Europe to some extent. I think because of a lot of pushback within the U.S. on that. There's been a lot of pushback on domestic issues like, ICE enforcement of anti-immigration curbs and so on. And of course, there was a lot of pushback on, trying to pack the Fed board and to try and put in a new Fed chairman who would do his bidding and cut rates. And so I think if you put all of these things together, somewhat along the lines that was being said previously, but I would go even further. I would say, President Trump is facing some of these famous checks and balances and institutional constraints in the U.S. system that seem to have been quite absent in the past, right? And I think that is putting at least a bit of short-term pressure against de-dollarization and against this idea of debasement of the dollar. Now, I think why choose Warsh? I think, it is a bit of a mixed signal. It suggests that perhaps, there'll be an effort. I don't think they'll get very far, but they'll make an effort, or Warsh himself will make an effort to try and reduce the Fed balance sheet over time, right? So that would drain liquidity from the U.S. system and by extension from global markets. On the other hand, we might get lower rates than otherwise as a result, right? Because if you have a smaller balance sheet and less liquidity sloshing around in the U.S. banking system, you might need to offset that and in the U.S. financial markets and economy more generally, you might need to offset that with somewhat lower rates than had the Fed balance sheet been roughly where it was, right? So very, focused on that issue. Plus, the Treasury, U.S. Treasury, has been shortening the duration of its issuance. The average maturity of the U.S. debt to some extent, sort of crowding more of it into the short end of the market, shorter term maturities where yields are lower, rather than issuing in the long end. So I think all of these things are, pointing to some of the removal of these pressures, particularly in oil and in gold and other precious metals. The industrial use, we could sort of say, okay, well, let's hold that constant, put it to one side for a second. But it's this, domestic and geopolitical factors that are taking some of the froth off, right? So I would say I agree. I think, the de-dollarization effort will continue, but there'll be less perhaps of this debasement fear and maybe less of the speculative froth in that market. So I would hope that the gold market, would hold up at some point, but become somewhat less volatile and behave a bit more like the safe haven, that it is purported to be, and that I think all the central banks would agree that it is, whereas almost none of them would agree that would be the case with, say, cryptocurrencies or digital gold, as some people have called it. Right?
Absolutely. Mr. Das, so much is shifting globally, and since, you analyze globally, global shifts. Now, since the start of 2026, of course, U.S. Taking over Venezuela, then the India-U.S. trade talks, India-EU FTA, of course, yesterday's call between Trump and Xi. How do you see all of this shaping the market, the metals, the precious metals, the oil going forward? What is your prediction for, let's say, the next 4 to 5 months? How does the retail investor and also, generally, like big companies, look at all of these developments going forward?
Look,
because
I think
so much is happening.
Yeah. Absolutely. Absolutely. And, President Trump is well known to, like the idea, I think, of flooding the zone, as they call it, right? Creating a lot of noise and a lot of uncertainty. And I would say, that is, more or less a feature of his style and his administration's approach rather than a bug. But having said that, I think, over the next several months, the focus is very much going to be on the midterms in the U.S., which traditionally don't go very well for the incumbent, particularly when, as in this case, a lot of things seem to have happened and a lot of policies seem to have been undertaken, policy reversals to some degree, that create a lot of uncertainty, a lot of volatility in the market, and have some real economic impact that undermine his popularity in the country in general, even if less so with the Republican base, right? So I think that's one of the things that everybody's going to be focused on in the markets and in the business sector, and of course in Washington and in the White House. And I think therefore he's going to be somewhat calmer. I wouldn't necessarily go so far as to say he's going to calm down fully, but I think he's going to be somewhat more circumspect than he has been, and try to be more gradualist and a little less radical. I would say I think this is the way he has been operating all along. He set something out there that I would call a bark, right? A very loud demand for something. Give me Greenland. I'm going to take control of Venezuela. We're going to have 100% tariffs. Whatever the case may be. And so the market at some point worries quite a lot about this extreme outcome. And then the actual outcome is much less than he barked. And so his bite is less than his bark. And people call that taco, right? Trump always chickens out. But actually, the bite is a lot worse than people at that point think. And then the market is in a position of somewhat celebrating that this bite has been taken out of something by calling it a taco, right? So tariffs, for example, they're not the 20%, 25% that they might have been at an overall level. They're still over 10%, the effective tariff, which is still around 4 times what they were before Liberation Day, right? So I think, anyway, where I'm going with all of this is I think we should expect somewhat less certainty, somewhat more stability, and hence somewhat less of a political risk premium, a Trumpian, a geopolitical risk premium in the short term. But I don't think he's done creating uncertainty over time.
Right. Right, Mr. Das. So he's going to be more circumspect and less radical. Well, that is expected to bode well for the market. So let me come to you on that note, Mr. Subramanian. What is the range that you expect for silver and gold to be trading in leading up to the midterms?
Well, that's a pretty long. I don't think you can take. That's still 9 months away from the midterms. So all right. I don't think.
So what are you going with?
See, what I'm going with is at least a double-digit appreciation from today's levels till the year end. If you want me to put a thing, I think a double-digit. Now, double-digit can be a big range, but I would talk about the mid-teens because I think that reflects a generic de-dollarization demand for these metals added by the shortage of supply for silver. I think combined with these two things, I think expecting a mid-teens rise in those prices of the precious metals, I would say is something that I think will happen.
All right. Over to you, Mr. Das. With 1/5 of only, I was just reading it here, 1/5 of only global oil which passes through the Strait of Hormuz, can a diplomatic breakthrough in Oman actually provide long-term supply, stability, or, do you think the market is prematurely celebrating this?
It could be premature, I guess. These things are always, hard to know when such core interests, particularly for a country like Iran, are at stake. But I think, what the market is concluding is that, in a way, Trump is succeeding in putting a cap on the long-term price of oil, on top of, the issues of, whether we're having still in other parts of the world, maybe not so much the U.S., a bit of a transition to some extent away from oil towards renewables, or away from fossil fuels in general, including oil in particular, towards renewables. If on top of that, kind of leveling off of demand growth, or slowing down at least in demand growth, you have the prospect of supply coming back into the market, you should see some pressure in the oil price. I think you can also see elements of that in the spread between the Russian grade of oil and Brent, right? That spread has widened against Russia in recent months. So I think, you do see a lot of reasons to think that although the geopolitical tensions remain among, or between the U.S. and other major oil producers, they're going in a way that instead of these risks pushing the oil price up, which is, the regime that we used to be in, we are in a situation now where the pressure through, alternative sources of supply with this demand constraint from the transition, at least in some countries, those factors are holding down the risk premium in oil. And like I said before, I think, this is a very important priority for Trump himself, because he identifies this as a major factor in driving up U.S. inflation. And although he might want lower rates, he doesn't want higher inflation, right? So he has to do things to offset that inflation pressure that maybe otherwise come from oil, or from tariffs, or from tightening the labor market through the immigration curbs that he's imposed, quite sharply in recent months.
Right, Mr. Das. Mr. Subramanian, when we talk about silver and copper, I mean, yes, we can talk about the fact that, of course, these have been rising on account of what we're seeing on the geopolitical and geoeconomic front. But we also have to consider the fact that domestic policies, particularly if we see India, for instance, there are domestic policies and industrial demand, which is also leading to the price rise of these commodities, particularly silver and copper. So what kind of rallying do you see in these two particular metals?
I think we just answered that question, right? I mentioned a double-digit mid-teen kind of a rise in the precious metals, and copper, I think, is just a follow-through of the whole. See, there's this talk of this commodity super cycle, which I think is overdone, okay? Because it's been a rally across all the metals, and especially, if I may comment on the oil part, right? For me, I look at this as another way of Mr. Trump putting pressure on Russia too. So first of all, see, if you look at the International Energy Agency, right, they are predicting a 3.7 to 4 million barrel excess supply of oil, even without Iran getting solved or Venezuelan oil coming into the market by the end of the year. So clearly, oil is on a downward pressure, and there are reports of it, Brent at least going below 60 or even touching 50 in case of the price. So and the reason why I say this, lower oil prices, if they were, let's say there's a peace deal of some sorts with Iran, right? And so Iranian oil comes back into the market, and India, which has got a very close relationship with Iran oil, is allowed to buy it again. Right? To that extent, we won't need to buy Russian oil. Similarly, whatever Venezuelan supply, let's say, was to Cuba, whatever little supply was coming, if that's going to be diverted to India, it means that India, if it gets cheaper oil from there, will, from a pure economic sense, buy less from Russia. Now, they may not stop buying oil from Russia, but lesser from Russia. So the point is that if oil prices go down and India is a big buyer, is not buying so much Russian oil, then that's going to hurt the Russian economy. And it's a way of economically trying to bring Russia to a more reasonable dialogue table on the Ukraine front, right? It could be a master plan of Mr. Trump to do that, because Iran is a slightly lesser problem. And all of this, behind all of this, I still feel that he still wants to make a bid for next year's Nobel Peace Prize. Okay, so he's building the case. So if he can pull off a Russia-Ukraine, kind of a win there, he'll then say, oh, I should be given this. So I'm just saying that Mr. Trump might be playing it in a different angle. And that's one of the reasons he signed he announced the trade deal with India, because what the oil part of it is probably going to be the Venezuelan oil, which is going to be sold to India as a substitute for us buying from Russia. So I still feel that this is a part of that kind of a game plan of Mr. Trump. I have no evidence to prove what I'm saying, but I'm just guessing that lower oil prices not only help into lower inflation in the US, it helps bring down Russia's economy and hence probably a more less combative Russia in terms of the talks with Ukraine. That's one thing. So otherwise on the metals and right side, so you have the precious metals. So gold and silver have a different safe haven. Now copper is clearly a supply situation. As industrial demand goes up, we know silver is the best conductor of electricity, but copper is slightly behind, aluminum is slightly behind. And there is no fresh mines being discovered with the rate. So there's a genuine industrial demand scenario, which is drying up the non-precious metals pack. So there, I think there is a supply-driven price rise expectation. But then, unlike in a precious metal situation where we can look at a de-dollarization move, at what rates are emerging countries buying more gold and silver and try to put a thing. In the case of other metals, the industry complicates it. So it's very hard to say that this is the rise in price we can expect. I think everybody who's ever tried to predict metals has got it wrong. I think next to currency is probably the most unpredictable price in this. But yes, there is an upward pressure even on non-precious metals due to a supply situation.
Yeah. But so now what are you saying? Shall we buy the metals or not? Will there be a further dip or not? What is your estimate and what is your prediction?
So my sense is that, metals at this point in time, the broader metals pack should be a part of your portfolio, probably 10 to 15%. And I would recommend that you buy them in staggered lots because speculative forces play a major role. And sitting in India, the complexity is that while demand and supply of these metals are driven locally based on housing and infrastructure and all of that, the prices are set in the London Metal Exchange or the COMEX. So that's one thing out of their control. So to that extent, it's a very good play for an Indian investor against a currency devaluation because the prices are set in dollars. So I think that metals should be a part of your investment pack, 10-15% share, but do that staggered because volatility is here to stay.
It's staggered. All right.
Let me come to you, Mr. Das. Mr. Das, how should investors be approaching this market and particularly with respect to this entire pack of precious metals? What would your advice to investors be?
Well, I think I agree with what's just been said. I'm not sure I would go so far as to say 10 or 15%, but I think most people would have a much smaller allocation to precious metals and also to industrial metals than that. I suppose you can construct that exposure through the metals themselves or through stocks that are linked to that, and I think there's much more of that going on, and I think both things make sense. I agree that there's this electrification question, this need for more energy for the transition, more energy for AI and for the data centers, and more wiring of grid to support all this compute. All of those things, sort of point in that direction. Plus, on the precious metal side, particularly gold, you have this geopolitical uncertainty that we've been discussing. It may be coming off the boil in the short term, but I don't think anybody's under any illusions that the competition and rivalry between the US and China will continue. And if anything, all the things that we're talking about point to stalemate. Not, to one side or the other, quote unquote, winning or gaining tremendous advantage over the other. Maybe yes, for some things in some sectors, for China or for the U.S. in other areas, right? But overall, I think we're looking at a stalemate, which suggests that the competition, economic competition, competition for influence over the world, over emerging markets, has just been discussed. I mean, I fully agree that this idea of putting pressure on Russia is there. And like I said before, the sanctioning of Lukoil and Rosneft, which is a step the Biden administration and the Europeans were not willing to take previously, that is being done. Pressure on India, which India appears to be, seems to be responding to. And then that relationship being somewhat improved, all these things are continuing and continue to point to pressure on Russia. On China, I think it's a kind of open secret, right? China has the upper hand when it comes to rare earths and critical minerals. The U.S. probably still has something of an upper hand when it comes to financial firepower and even the role of the dollar. I guess tariffs, right? The big, beautiful word of tariffs. So there are things, pointing to a cooling intentions, but I don't think we can say that there's a full-blown detente or any move towards really one side or the other climbing down. So I think all of those things will
a
hold
cooling
up.
intention. Yes, absolutely. Mr. Das and Mr. Subramanian, I'm afraid we have to wrap this conversation because we are running a little short on time. But thank you so much for joining us today and sharing your insights and inputs with us. Now, moving on, up next, an exclusive roundup of week's key developments from Maharashtra in our Maharashtra 360.